Welcome to IQD DINAR News, your go-to source for the latest updates on currency exchange rates, revaluation news, and insights into the Iraqi dinar. Stay informed and ahead of the curve with our timely analysis and breaking developments. The lowest possible value for the currency in question could be around 0.76 cents. However, they expect a higher revaluation, possibly in the range of $3 to $4, which they believe makes more economic sense. The writer also notes that there are still suggestions indicating that the revaluation could be even higher than that. Expanding on this, let's first break down the concept of the real effective exchange rate, Reer. The Reer is an important economic measure used to assess the value of a country's currency relative to a basket of other currencies. It takes into account inflation differentials between countries, as well as trade balances, to provide a more accurate picture of a currency's real value in the global economy. The Reer is used by economists, policymakers, and financial analysts to gauge whether a currency is overvalued or undervalued, which in turn influences decisions regarding monetary policy and foreign exchange rates. In the case of currency revaluation, the Reer can provide insights into what the adjusted value of the currency should be once market corrections are made. For example, if a country has experienced prolonged periods of inflation or has maintained an artificially low exchange rate, the Reer can reveal that the currency is undervalued in real terms. A revaluation would, therefore, adjust the currency upwards to reflect its true economic value, taking into account its trade relationships and inflation compared to other countries. When the author of the paragraph mentions the worst-case scenario or bare minimum value of 0.76 cents, they are likely referring to a theoretical lower bound based on their understanding of the Reer. This might mean that even in a conservative estimate, where external factors and market forces might push the currency to a lower level, it is unlikely to fall below this value. This 0.76 cent figure could be the result of a series of economic calculations, such as inflation differentials, purchasing power parity, PPP, and trade balance considerations, all of which influence the Reer. Moving beyond the worst-case scenario, the author suggests that a more reasonable expectation would place the currency's value in the high $3 range or low $4 range. This assumption may be based on stronger economic indicators, such as higher growth forecasts, increased foreign direct investment, FDI, improvements in trade balances, or a strategic shift in monetary policy designed to attract global investment. A higher currency value would not only reflect a stronger economy but could also be an intentional move by the country's central bank or government to make the currency more competitive in global markets. Revaluing the currency to a higher range might also attract international investors, boosting the country's economy further. Furthermore, the belief that the revaluation could be even higher than $4 suggests that there are still factors that could lead to an even more optimistic outcome. These factors might include geopolitical developments, global economic shifts, or internal policy changes that are expected to create further upward pressure on the currency. For instance, if the country in question discovers new natural resources, negotiates favorable trade deals, or stabilizes its political situation, these events could cause a positive reassessment of its economic prospects, leading to a higher than expected currency valuation. To provide a more comprehensive understanding, let's delve into the broader implications of currency revaluation. A significant revaluation of a currency can have various economic consequences, both positive and negative. On the positive side, a stronger currency can lower the cost of imports, making foreign goods and services cheaper for domestic consumers. it can also reduce inflationary pressures by lowering the cost of imported raw materials and finished goods. Additionally, a higher currency value can increase the purchasing power of the country's citizens when they travel abroad or invest in foreign assets. However, there are potential downsides to a currency revaluation as well. A stronger currency can make a country's exports more expensive for foreign buyers, potentially reducing demand for those exports. This could negatively impact the country's trade balance, especially if it relies heavily on exports for economic growth. A sudden revaluation could also disrupt domestic industries that depend on exporting goods, leading to job losses and slower economic growth in those sectors. Another critical aspect to consider is the role of monetary policy in the context of currency revaluation. Central banks often manage exchange rates to stabilize their economies and achieve specific macroeconomic goals, such as controlling inflation or stimulating growth. In some cases, countries may maintain a fixed or managed exchange rate, pegging their currency to a stable foreign currency like the US dollar. In such scenarios, revaluation would require deliberate policy decisions, such as adjusting the peg or moving toward a more flexible exchange rate system. For example, a central bank might choose to revalue its currency to combat inflation by making imports cheaper or to align the currency with its true market value, as indicated by the Reer. Conversely, a country facing economic challenges might devalue its currency to boost exports by making them cheaper for foreign buyers. However, revaluation is a delicate balancing act, as it affects various aspects of the economy, including inflation, trade, and foreign investment. The author's expectation that the revaluation will occur in the $3 to $4 range likely stems from a combination of factors, including an assessment of the country's economic fundamentals, geopolitical considerations, and potential future growth. These projections might also be influenced by speculation in financial markets, where investors may be anticipating positive developments that would justify a higher valuation. It's important to note that currency markets are influenced by a wide range of factors, including global economic conditions, interest rates, political stability, and investor sentiment. As such, while economic models like the Reer provide a useful framework for predicting currency values, actual outcomes can be affected by unpredictable events. In conclusion, the paragraph reflects a perspective on currency revaluation grounded in an analysis of the Reer. The author presents a worst-case scenario of 0.76 cents while expressing optimism that the revaluation will likely fall in the $3 to $4 range, with the possibility of even higher values. This outlook is based on a combination of economic analysis, market expectations, and possibly insider information or expert opinions. The broader discussion of currency revaluation highlights the complex interplay of economic forces, monetary policy, and market dynamics that influence exchange rates. Thanks for tuning in to IQD Dinar News. Don't forget to like, share, and subscribe. For more updates on the Iraqi dinar and global currency trends, hit the notification bell so you never miss an update. See you in the next video.